Now, if our buyer says, hey, look, I have done everything I can over the last 5 years and the last 2 years to save 25 grand, and that's all I have, then we know what strategy to go with.
We just do a 3% credit, 26,000.
Jason's not scared to ask for it. So that is a big plus, especially now. But I'm saying even back in the tough times when it was a seller's market, he's fearless.
All right, everybody, how's it going? Happy New Year. We're here with Chad Cockrell with Guild Mortgage, and he's going to be breaking down and demystifying what it actually takes to buy a house. You know, there's a lot of misconceptions out there, and people think that, you know, maybe a house costs way more than it actually does. Chad's going to break it down for you, and he's going to show you the difference between all the different loan programs and what exactly you're going to need to get into a house. All right, Chad.
Thank you for having me here, Jason. I really appreciate it. Yeah, and I just really like to help people understand more about the process. We want to be a big source of education. And one of the things we find is people are very confused on exactly what are closing costs and what are prepaids. That is, prepaids is like the Bermuda Triangle of the loan process. People go, wait a minute, what's all this extra money I need? Are these closing costs or what is this? And so I love this opportunity to break down what exactly are closing costs, what are prepaids, how much money will you need for a transaction, how much seller credit do we need to get?
All right, Chad. Well, hey, break it down for us, man.
All right, let's go.
All right, so Chad, what are you showing us here?
What I am showing is a loan comparison sheet that gives basically it's a loan estimate. And there's various forms of this estimate. In other words, every loan officer or loan company is going to have a different version of this. When a buyer applies for a mortgage and they go into escrow and it becomes a live transaction, they will get the official loan estimate, the CFPB official loan estimate. That CFPB stands for Consumer Finance Protection Bureau, and they have a standard format that all lenders are to use. But in the very beginning, when we're consulting with buyers, we can use whatever software we want. This is the software that we created at the Lynn Chad Gold Coast team, but it's a very standardized format. And other lenders may be using Mortgage Coach or have their own proprietary software.
I've seen Mortgage Coach before.
Yes. So what I'd like to do is basically walk through this loan comparison on this particular scenario, the conventional 5% down, because I want to demystify what are closing costs and what are prepaid items and how much money is truly needed to close a transaction.
Well, break it down for us, man.
Okay, so let's go through a scenario here on a conventional 5% down. And let's assume that we have a $500,000 purchase price. And our buyers have 5% down, which equals $25,000. So that means their first mortgage, and it's a conventional loan. So the base loan amount and the final loan amount are going to be the same of $475,000. So the buyer goes, yep, I've got $25,000 that I can put down on this home. And we go in and we say, okay, we did some calculations on closing costs, and they're about $10,000. Here in this scenario, $10,617. And don't worry, I'm going to break all this down into more detail. This is the summary sheet. But a lot of lenders kind of pump out this kind of stuff where it's very broad based and they don't get into specifics. And now we do both. We start on page 1 with a summary sheet. Page 2 is a detailed sheet. So we say, okay, closing costs are going to be around $10,000. Okay, well, let's ask the seller to cover that $10,000. Okay.
And so right now in this market, that's pretty normal. Like, we should be able to get credit.
Yeah, absolutely. But let's say we only ask for 10 grand. So the buyer's thinking, oh, well, I have to come up with like 25,000 and a little bit of change here that they didn't cover. But then they go to closing or they get their loan estimate. It says 31. And they're like, wait, I had 25 down. I have 10,000 in closing costs. I got a seller credit of 10 grand. But why do I have to come in with 31? Well, there's this little mystery, I call it the Bermuda Triangle, where people get really lost in it, called prepaid costs. And I'm going to explain what those are. So obviously, if we did some calculations and we know, like essentially what title and escrow company we're going to be using, ballpark, you know how that works, where the seller picks the title and escrow company, so it's not an exact science. But we also know what time of the month and what time of the year we're closing, and we know more about the property. We can also get more details on what these prepaid costs will be so that we could go in and ask for the right seller credit. So if we're having this conversation, we say, what are closing costs? Well, technically closing costs are around 10 grand. And you say, well, I'm gonna get the seller to pay that. Well, in this scenario, we'd probably want to go in and say, wait a minute, we're going to have closing costs. And depending on what time of the year, and then I'm going to show you a scenario where we close in the middle of the month and go, well, wait a minute, we need to account for this other $5,700 that are not transaction fees. That's where it gets confusing. These are transaction fees. These are not transaction fees, but it's money you need at closing. So therefore we go, let's adjust our strategy. So we go in and maybe go for, if the buyer says, all I got is 25. Well, then we're going to the
we ask for
seller.
a 3% credit.
Then we're going to the seller saying, look, we can put this deal together, but we've got to ask you for 16, in essence, 16 and some change. And we can make that cash to close 31,000.
On this conventional loan, how much credit can you request from the seller?
You get
because some of the loans, it's 3% max, right?
Yeah. Yeah, it's based on loan value. So they can get 3% on this loan.
Okay.
On a VA, FHA, and USDA, they can get more, but yeah, and the credits depend. If they had 10% down, they get more credit. They have 20% down, they get more credit.
Okay.
So this, again, in our summary, we look at it from 10,000 feet up. We go, hey, you're buying a place for 500,000. You've got 25,000 down. There's a $10,000 seller credit. Worst case scenario, you're coming in with 31,386. And it's a fixed rate loan. Let's say it's 6 3/8. Actually, rates have dropped here down a little bit, but of course, it's been a topsy-turvy year in 2022. There is no second loan, so this is kind of grayed out. Very common on these loan comparisons to see the payment breakdown. We have your payment on your first mortgage. This is a 30-year fixed, no balloon, no prepayment penalty. Because there's only 5% down, there's mortgage insurance. Then there's property taxes in the realm of 521, homeowner insurance of about 100, and that comes out to a total of 3,700. Okay,
I can't imagine people are paying less than like $2,500 to $3,000 a month for rent right now.
Correct. And what we find is they're probably paying more, like if they're in a home, they're at a minimum 2,800 to 3,000. But let's just say, and we should do another video on rent versus own analysis, because if you're paying 28 to 3,000 and you've got an opportunity to buy a home at 3,700, I'm telling you, within 5 years, your rent is going to be more than this 3,700. Okay.
Well,
and I want
unless you live in River Park, because River Park, I just had a client call me. They're renting out, I forget what the complex is called, but they're paying $3,000 for a condo.
Oh, easily. Oh, I think that would be 32. It must be a small one, because if it's a decent sized one, it's going to be 32 to 3,500.
Crazy.
Now, here's the thing, too. You got to remember, this is a 30-year fixed rate loan. This is never going to get any higher. This is fixed forever. This is going to stay the same. Mortgage insurance eventually, I can't say when, because it depends on what happens with the market, but this eventually could go away. So, and you could actually go down to 3,600 in some future event. Now, property taxes and insurance can have some minor adjustments, but I mean, we're talking maybe if the two of these went up $20 a year, I'd say that's a max. I mean, between the two of them. So $3,700 is pretty well locked in, whereas rent is, I've heard of an 11.9% rent increase in River Park this year. And but a lot of people are taking 5 to 8% rent increases. So 3,700 is the worst it's going to be. And guess what? When rates go down, we refinance this 6 3/8 into 5.5, 5 3/8. This goes down. Maybe the PMI goes down or is eliminated completely. These don't change at all when you refinance. So this is the worst the payment's ever going to be. It's going to get better because we know the PMI will eventually go away. So what we have on our sheet is a cash to close summary. So again, this green section deals with this up here. We go, down payment equals the home's purchase price minus the base loan. Well, that's pretty simple. 500 minus 25,475. Very simple math. The down payment plus closing costs plus prepaids equals the total cash to close. And again, that's where we had the down payment minus the seller credit, add the closing costs, add the prepaids. That's the total cash to close. Closing costs are one-time transaction fees associated with both the purchase of a home and the cost of getting a mortgage. So if somebody says, like, I won the lottery, I'm going to buy a house cash, they're still going to have closing costs. They're going to have title and escrow fees, recording fees, some notary fees. They're not going to have lender fees, but they're going to have some purchase of a home fees. And then, of course, if they're getting a mortgage, they're going to have some costs of getting a mortgage. Prepaid costs are not transaction fees. These pertain to ongoing property-related expenses such as mortgage interest, property taxes, homeowner insurance, and HOA dues. So some of these fees will be prorated depending on the month and the year, time of the month and time of the year the transaction closes. So, and some of these monies are going into the escrow account. So of this $5,700, some of this money is going into their escrow account to cover future property taxes and insurance.
It's going to cover their whole 12, like the first 12 months of homeowners insurance,
12 months
right?
of insurance, 6 months of taxes.
There you go.
So, and then we kind of talk about what a payment summary is. We explain how interest rates and loan origination points work, but let's go into the details. So let's go down. So here's more of our detailed loan comparison. So now it's broken down with a lot more detail. So 500,000, 5% down, 25 grand. There's that 475. So the down payment's 25 grand. We've got a seller credit of 10 grand. 6 3/8. We've got our mortgage insurance. This is what we call the lender payment, where this is what the lender's going to collect for them. It's a 2963 plus the PMI. They pay the PMI. So this does not include taxes, homeowners insurance, or HOA dues. This is just the lender portion. Now, closing costs. Okay. Every lender has a myriad of fees, and they name it 17 ways until Sunday. Okay, they call it underwriting, doc prep, MERS registration, tax service, processing. I mean, there's a million names for whatever their fees are. I just lump it together and I call it admin fees. Yes, sometimes we in the industry, and being totally transparent, we call it junk fees. Every lender has them. Okay. Then in this scenario, we had the buyer paying 1 point to get that better interest rate. In other words, they could say, well, I don't want to pay 1 point. Okay, well then your rate might be 6 5/8. I want to have 5.99. Okay, then you're gonna pay 2 points. Okay, but let's say in this scenario that day, 6 3/8 was 1 point. So there's 47.50. That's 1% of the loan amount. So the reason why they call it points is not to get confused with the rates. So you say, I have a 6 3/8 is my rate, 1% is my points, but it's a 1% of the loan amount. Appraisal's 550, credit report, say 51. Now here's where it's going to vary, because escrow fee and title are going to be dependent on who the seller picks to do the escrow and title. We typically over here at Guild, we have a philosophy. We always run these numbers high because we don't know if they're going to use a big brand, more efficient and more affordable title and escrow company. They might use a boutique place like Beverly Hills Escrow and they charge a little bit more. Now, the buyers go, well, why are we picking them? Well, in our county, the seller pays this owner's policy, so they get to pick who pays for that. I mean, they get to pick the provider. In other counties,
it is negotiable.
Okay, fair enough. But typically, if you say it's negotiable, do they say, well, then you're going to pay part of it? In practicality,
I've had many times where the seller still pays their fees, but they're going to go with the company that we choose. Just kind of depends on where we're at in the market. The market we just left. Forget about picking your own escrow and title. But the market that we're in right now, it's definitely doable. Okay,
that's good to know. So in this case, escrow fee, this is for a neutral third party to be the intermediary. Then escrow fee is neutral to all parties. So they handle all the money going to and from the seller to the buyer, to the seller's lender, to the buyer's new lender. Basically, it's like a clearinghouse. They do what everybody wants to do and make sure that all the monies are exchanged the way it's supposed to go.
Neutral third party.
Yep. There's two types of title insurance. One is an owner's policy, and unfortunately, I wish California would restructure this. There has to be a separate lender policy because the owner's policy only covers the buyer and the seller. In Ventura County, the seller pays this fee, but in other parts of the state, this is split. So basically what this does, it ensures that there's not a defect in the chain of title. When you're buying the home, you're not having to worry about somebody having a claim against your home. Oh, somebody knocks on your door. Hey, I own this house. What do you mean you own this house? Well, 20 years ago, somebody deeded it to me. No, it'll insure against that. Or somebody pulls up with, this is an extreme case, but somebody pulls up with an oil drilling rig and says, hey, I'm going to start drilling. I have mineral rights to your property. What? Or somebody says, yeah, I'm going to start walking through your backyard. I have an easement. You're like, no, you don't. And if they do, and it was not disclosed, you're going to be indemnified through this title insurance between the owner and the seller and the buyer. There's also title insurance for the lender. So the lender wants those same coverages because they have a lien against the house. This is the security for their loan. So they want to make sure that there isn't somebody who's going to come make a claim or somebody that's going to make the property less marketable because they set up an oil drilling rig in the backyard. So this covers the lender. And because the buyer is the one getting the loan, they pay for that. Recording somewhere in the 175 range. And we typically throw in $500 for miscellaneous escrow charges. If it's a condo, we'll add, and the buyer's paying for the transfer fee, we'll throw in a little bit more here. But this covers like notary. And honestly, like we have some admin fees, some kind of junk fees for the lender. Be honest with you, escrow and title will have a little bit of junk fees. And so this is a catch-all. So
well, a lot of the time too, they charge more and then they give you a refund. They just want to make sure to pad, so that they collect enough money.
That is correct. So yeah, $10,617 is how we came up with our closing cost subtotal. These are one-time transaction fees. Then going into prepaids, this is where there's that Bermuda Triangle where people don't realize, wait a minute, what is all this? Well, let's say we're closing mid-month. So we would prorate 15 days of interest. And I tell somebody, I go, look, if you moved into a rental on the 15th of the month, would you pay a full month of rent? They go, no. I go, because you wouldn't live there for the first 2 weeks, right? Yeah. You'd only pay the prorated daily rate. Correct. That's the same thing here. We'd have a daily rate and it would come out to $1,244. If it was for 30 days, it would be obviously double that. And if it was 1 day, it would be just a few bucks. Now, one thing about a mortgage that's kind of cool is typically you don't have a payment that first month. So if we're closing January 15th, your first payment is March 1. Okay. We basically collected interest for January and your March 1 payment covers your February interest. That's a whole nother video.
And if you get a credit, it's almost like they're paying for your first month to live there.
Absolutely. Then we know that taxes are 6 months. So what would happen, because we're going to assume they're setting up an escrow account, and actually they would have to because they have less than 10% down on a conventional loan. So
if you have less than 10% down, you have to do impounds?
You have to do an escrow account, impound account on a conventional loan. So 6 months taxes, we're going to figure out. Now, this rate, this dollar amount is based on what it's going to be. So if the seller has owned this house since 1972 and they pay $500 a year for total property taxes, we can't go off that because we know with Proposition 13, it's going to be a certain percentage off the acquisition cost or the purchase price. So we're going to calculate so that we're prepared. So we're going to put 6 months of $521 into that escrow account. So when that tax bill comes out in March, it's paid for out of that escrow account. That's not extra money your buyer has to come up with. So this would be the bill that comes out in March, and everybody can take a big sigh of relief when they see that bill come in the mail because they go, whew, my lender's got this. Nice. Now, insurance is going to be 14 months. What's going to happen is we're going to send 12 months or $1,200 to the actual insurance company, and 2 months is going to go into the escrow account. And yes, this is where there's even more confusion. People go, well, I just paid for this year in advance, so why do I have to pay it in my monthly payment up here, or actually down here? Why do I got to pay that extra $100 a month? Because we are following a schedule set up by the CFPB. Again, that is a government agency to protect consumers, and they have set up a schedule that every lender uses on every loan that has an escrow account. They have very strict rules, and we all follow it. So this is how it is this is the law of the land for every lender. And so they're going to say, look, it's okay that you pay 12 months to the insurance company, put 2 months into the escrow account as a pad. We're going to even have a little bit of a pad here on the taxes. And that is going to mean that if there's a slight adjustment and these fees go up a little bit, that your lender is not going to contact you and say, oh, you're short on your escrow account.
Right.
They have a little bit of pad money there to cover it. Now, every year, every lender is required to do an audit on every loan that has an escrow account. And if there's too much money, there will be a refund. That does not help us today. So we've got to plan for what the expenses are today. And if there was prorated HOA dues, that would be in here. So this is where that $5,700 comes in. Now, keep in mind, when you finally sell your home and you pay off the mortgage, this money, the monies that are in your escrow account, you're going to still have some money left over. It's going to come back to you in a refund. So eventually down the road, you're going to go, oh, there's a little bit of slush funds coming my way. But we have to understand, we have to know, like, when are we closing? What time of the month are we closing? What time of the year are we closing? What's the insurance going to be so we can cover this? And that's how we came up. So again, just everything in green, 25,000 minus the 10,000 seller credit, add the one-time closing costs, add the prepaid items. That's how we came up with 31,386 total cash move-in with a total payment of 3710. That includes the 2963, the 127 for PMI, which will eventually go away, 521 for property taxes, $100 for homeowner's insurance. So that's what it would look like. Now, if our buyer says, hey, look, I have done everything I can over the last 5 years or the last 2 years to save 25 grand, and that's all I have, then we know what strategy to go with.
We just do a 3% credit, 26,000.
You could do that, and now you have some money. So now you say, okay, wait a minute, where are we going to spend all that money? Because see, I can only spend right now. I can only spend 15. I can't use any of that seller credit towards their down payment. But what we can do is go, you got me that much credit, Jason? You're awesome. You're an amazing agent. And let me tell you, Jason's not scared to ask for it. So that is a big plus, especially now. But I'm saying even back in the tough times when it was a seller's market, he's fearless. He'll ask for it. And, they'll just counter it back out. If it doesn't hurt work.
To ask.
It's right. Hey, there's many times I've seen agents that are way tepid and don't ask. And it's amazing because the ones that ask get it. Your mama said, you don't know until you ask, right?
Right.
So what we would do then is we would get really aggressive on putting more money into the points to buy the rate down. The more money we give a lender up front, the lower the rate, they'll drive the rate down. Or we could do a 2-1 buy down. Or we could get an amazing home warranty, like an extended warranty, which would show up on the buyer's side.
That's if we get more than 3%, right?
Yeah. That's if you get more than this 15,000. So if you got more than, $16,300, basically 16.
Yeah, then we could just apply it towards the rate.
Then we can say, okay, you got me more money, because on that price of 500,000, so I don't have 15 grand of cost. But what I will do is I'll make sure we get all of it. So we'll get more aggressive on the points, or we'll get a better home warranty policy. Different ways to skin that cat. So. But this, I hope, helps demystify some of these numbers, because what happens is a lot of times you'll talk to a lender, or some buyer will talk to a lender, and they kind of see these numbers, and they do, like I said, they're trying to keep it simple, and I understand. That's why we have our summary sheet. And they see this, and they're like, okay, that's great, but how did you get to this number? What are closing costs? What are prepaids? And sometimes I hear buyers go, well, my closing costs, my transaction fees were 16 grand. It's like, not exactly. Your transaction fees were 10 grand, which is reasonable. This is not a closing cost fee. This is money going towards your property related expenses in advance. So we just wanted to, and of course, it helps when you see it broken down, because when you see your loan estimate, it will be broken down like this. When you see your final closing statement at the very end, when you're signing your final loan documents, you're going to see an itemized summary. So it's nice to have a summary sheet with just kind of some broad strokes, 10,000 feet up. But everybody always wants to know, how the heck did you get to your math? And this is what they're going to see at the end. So we try to create financial literacy right up front. We try to educate our buyers, like, here's the lay of the land. Here's what it is. And then we can have an honest discussion. Hey, Jason, we need 16 grand.
And that's why it's so important to get, pre-qualified, pre-approved,
yes,
so that we know how much money that we need when we write the offer.
Absolutely. Because if somebody comes to me and they say, okay, I have a 760 credit score. Okay, well, wait a minute. You're getting 5.99 with this 1 point, so you got a lower payment. Or you can have 6 3/8 for no points. Oh, we don't need as much. But if you come in and you say, well, I only have a 660 or 680, well, then this is, then you have this higher rate with that higher dollar amount. So, because the agencies, such as Fannie Mae and Freddie Mac, have price adjustments based on credit score. So it's a very crucial that we've actually, we can talk in theory. Somebody can say, hey, can you give me some numbers on, I think I have a 720 credit score. Absolutely, I can pop this out. But then if you go into contract and we told Jason we only needed 10 grand, and then we run your credit and we find out you only have a 680, well, now you're 6,000 short because you said you only had 25 grand.
Well, this is a really good breakdown, man. So how much cheaper is it? Like if you're going to go FHA, how much smaller of a down payment? Just I guess 1.5%. So you're saving like $7,500.
There you go. So 3.5. Here's the 3.5%. Would be 17,500. And we're going to assume the same seller credit of 10 grand and paying 1 point. Interest rate's a little bit better. Government loans are a little bit better priced. And on this one, it's 23,000. So, but the mortgage payment's higher by $235. So, because the mortgage insurance is more expensive and it's there for the life of the loan, plus FHA, to create massive confusion, our government does that once in a while, has an upfront mortgage insurance. So there's a fee of $8,400 for upfront mortgage insurance. We show it down here in the closing costs, but then it's added to the loan so they don't have to pay it out of pocket. So, looking like a VA loan would have $6,700 needed. So that's for veterans only. USDA.
That's the way to go right there.
Yeah, well, yes, correct. Some people would say, you know what? I could actually go join the military, be in the military for 2 years before I could save up this additional monies. That is the way. That is a way to go. Then there's USDA, but the problem with USDA is it is only in rural areas. And so what that means is you're looking at a map of where they will lend, and then you go look for homes in that specific little pockets. And I can tell you in Ventura County, that's not a lot of Ventura County.
What do we have? Santa Paula?
It's like Oakview, Ojai. Yeah, like I would say not even Santa Paula or Fillmore proper. I think it's like more outskirts. Be honest with you, that's where I would tell people, go, look, let's go to the USDA map. Let's look it up. But a lot of people don't like having to print a map and then try to find homes in these little circles. They want to live where they want to live.
Right.
But it is an option, and we offer it.
Just hopefully the house that you find qualifies if that's the route you want to go.
That is correct. But I will say that USDA is not as liberal as VA and FHA. They have some little bit tighter guidelines on debt ratios, and so that can be an issue at times. But yeah, the reason why these are lower down is both VA and USDA have 0% down. They have 100% financing options, whereas FHA has 3.5% down. Conventional does have 3% down, but I wanted to show kind of a standard 5%.
Okay, now what would be the downside of going the conventional 3%? Anything?
So the mortgage insurance would be higher. This PMI factor would be higher, so that would be a higher dollar amount. And then the interest rate may be a little bit higher depending on their income. If their income is below the 93,000 range, they can get some better pricing. But if they're over that amount, which is kind of what we need to qualify these days, typically, we're finding people are making six figures, then the interest rate would be a little bit higher. The PMI would be a little bit higher. So therefore that lender payment would be higher. The property taxes and the insurance would be the same, but this payment would be higher. More in line with probably like around the 3,900 range by the time everything.
Well, it's an option for some people that can't come up with the 5%. And
Absolutely.
Then on the majority of condos and townhouses, you can't even go FHA.
Correct. So that would be
3% conventional would be a big help.
Yeah.
And most of the properties in Ventura County at 500,000, that's what you're going to be looking at as like a condo townhouse.
Yeah, correct. What we encourage people is contact us sooner than later for a consultation. And what we do is we're very big on education. So we're going to educate them on how these programs work. We're going to give them coaching on how to get access to the best products and pricing. We're going to tell them specifically what they can do to get their credit stronger, their income stabilized, and their assets bolstered up to make an upcoming purchase.
Like, what is the best way for someone to get a hold of you if they want to run these numbers and basically see what they qualify for?
So they can email us here at lindaandchadteam@guildmortgage.net or contact us at our team line. We have a team of people, and we'll get a call back out to them right away.
Okay, awesome, man. Anything else you wanna add for our viewers?
The biggest thing is reach out sooner than later. The more time we have with you, the better we can help you. Think of buying a home as running a marathon. And if I said to you this weekend, oh, by the way, on Saturday, I signed you up for a marathon, you're probably not very, very happy. Don't even know if you would finish because you have not a lot of preparation.
I love it. No, it makes a lot of sense. So if you're looking to buy a home, you need to get started. I mean, I would recommend you start at least 90 days beforehand working on your loan.
Easily. I think if you said, I think I want to buy a home in the next 12 months, reach out. Because the worst that's going to happen is we're going to give you a bunch of education. We have stuff that we have printed in like a PDF we can send to you. We have over 60 videos on our YouTube education channel. I mean, so we could say, what questions you have, what topics do you want to learn about? And we're adding stuff all the time.
Well, that's why they should reach out to Chad. You guys should, if you're looking to buy a house, you got to reach out to a lender as soon as possible. Like Chad said, as early as 12 months. That's going to really change the whole scenario of buying a house. You're going to save tens of thousands of dollars over the long run with just a 0.5% interest rate difference. Yep. So I love it, man. You've been super helpful, super informational, and we're going to do another one of these soon. We're going to break down what exactly do you need to buy in this market right now. This is kind of general, but the market is shifting. If you don't know, it's getting easier and easier for buyers, so we plan on keep educating you about that. Any other things you wanted to say to wrap up, Chad?
Just reach out. We're here for you. We're here to help.
All right. Awesome. Thank you so much, Chad Cockrell. You're amazing. If you found this video super informational, please do us a favor and make sure that you subscribe, like, and click that bell for future videos or future updates.